Good afternoon, everybody. Hello,
Good
hello.
afternoon.
Howdy.
How's everyone doing?
Doing great. Great to see everybody.
Yeah, Robert was just checking in on us.
I see that. She's snooping. I just want to give it a few minutes, you guys, just to see, or give people a few minutes to pop on.
Sounds like a plan.
All right. It's a beautiful day here in Maryland. Sun shining.
It's nice in Florida too.
I know. So sad.
Yeah, luckily here in South Carolina we're doing good so far, but you never know with these type of storms. So fingers crossed.
Well,
Yeah, when is it supposed
pretty sunny as well, so throw that in there.
There you go.
That's nice. All right. Well, I'm just going to go ahead and get started. I know that we have an hour to be with you guys this afternoon, and time is precious these days. So we're going to go ahead and get started. And we want to welcome everybody to our sliding into fourth quarter webinar. We were trying to do a little play on baseball and our home team, the Orioles, making it into the playoffs, but that didn't last long. So anyways, welcome to sliding into the fourth quarter webinar. For those of you guys who don't know me, my name is Julie Long. I am the operations manager here at Armstrong Dixon. I've been with the team now for 6 months, believe it or not. So I may be a new face to you, but I'm not new to the industry. I did spend 14 years in the industry before I took a little bit of time off to raise my babies, which are not babies anymore. So they're all full-time back at school, which has allowed me the opportunity to come back into the industry that I love and with this amazing team. So I'm super excited to be here. You may see a little less or hear a little less from Katie Brown here in our office, and she hasn't gone anywhere. She's just wearing more of her compliance hat and taking on more of the partner role here in the firm, trying to keep us all straight. And I'm taking on more of the operations role behind the scenes. So again, you may hear a little bit more from me, a little less from Katie, but don't worry, she has not gone anywhere. She's still with us, and we still work very closely together. So just wanted to get that out of the way. A couple housekeeping items before we get started. I know we have a lot of good information for you guys today. Just wanted to thank everybody for joining us at our Family Fall Fun Day that we had this past Saturday at Lone Oak Brewery. We had such a great turnout. It was a beautiful day, such beautiful company. It just was truly a great day. So if you haven't had an opportunity to check out Lone Oak Brewery in Olney, Maryland, it's a great fun day for the family. So I know that we're talking about possibly going back again next year. But we also have a lot of events in the works that we've already started planning for 2025. So if you couldn't join us this past Saturday, definitely stay tuned because we have some really fun things planned coming up in the future. So that's cool. One other thing, as we are presenting, if you have any questions, please feel free to send Robin at Braswell@armstrongdixon.com. Go ahead and shoot her over an email with your questions. We'll do our best to get the questions answered during the webinar. If for some reason we can't get to your question, obviously we'll make sure that the appropriate person gets it and they'll get back in touch with you. And then as far as getting connected, if for some reason you lose connection, just go ahead and log out, log back in. And we'll also be recording. So if for some reason you can't get back in, we'll have a recording. If you want to share it with your friends and family that couldn't make the webinar this afternoon, you have the opportunity to do that as well. So that's all I have. I want to introduce you to your panel this afternoon, which a lot of these faces probably look familiar to you. Joe Breslin, Navarone Simpson, and Skylar Engelhardt. They're all CFP professionals. And we do also have one fresh face on our panel this afternoon. Her name is Margo Steinlage. I got that right. Sorry. She is the president and co-owner of the Steinlage Insurance Agency. So she's actually here to hopefully shine some light in a very complex Medicare market these days. I do want to mention we're not affiliated with Steinlage, but we do like to bring experts on to help help better serve our clients and to, knowledge is power. So with open enrollment coming just next week, I believe it's October 15th. Correct me if I'm wrong, Margo. I know you're super busy. But I'm going to stop talking. I'm going to pass the baton over to you. And Margo, welcome.
Awesome. Thanks, guys, for having me. Let me go ahead and share my screen here. Again, we're coming up on this open enrollment period. So this webinar is for anyone who may be approaching Medicare age at 65 here in the next few months or years. Anyone who has parents who are already on Medicare, or a spouse or family member on Medicare that you just want some additional information for. Or anyone who's coming off a large employer group health plan after age 65 and kind of retiring and moving into Medicare at a later date. This webinar is geared for all of you. A little bit about myself and our agency before I jump in. I want to qualify the expert witness. So I have my law degree from St. Louis University. I'm a Missouri born and bred lady, and I live here in Virginia. I moved to DC about, almost a decade ago. I have a few offices in the DMV, and we have our headquarters in Missouri, but we have clients in all 50 states. So if you're in Baltimore or anywhere in Maryland, or if you're down in Florida or California, we are able to service all of our clients on a national platform, which is really nice. All of our advice is free to clients, so do feel free to lean on me and my agency. Any questions that surface, just shoot me an email. I'll have my email up at the end of this presentation, or you can reach out to Robin or Julie and get my email. Again, it's all free, whether you're looking for an annual review or you're looking for cost comparison to a group plan benefit, a younger spouse at play, children at play, and what it will cost to move into Medicare. We are able to assist you in most capacities. So today I have about 25 minutes, so I'm going to kind of breeze right through the major talking points around Medicare, things that should be on your radar if you're new to Medicare or if you're already on Medicare, just some changes that are coming down. This will be a really good recap for anybody who is already on Medicare on how these different moving parts work. But really, we're going to jump into who is eligible for Medicare? What's the rule around turning 65 for those of you who...
Uh-oh. Are we all frozen?
For 2025, when you do approach Medicare eligibility. Julie, are we good?
I don't know. I mean, we were not, but it looks like we're back now. I see Skylar has popped back on. I apologize. Everything was frozen there for a minute. We could hear you, but we couldn't, like, your face was frozen. So we still got the information, but it was like, one of those really attractive poses.
Perfect.
It actually was a great, if it was going to pose at any spot, it looked perfect. But
I planned that. That was intentional.
Don't you hate that?
It was all good on our end over here, so I think it might be some connectivity issues at the office there, Julie.
Yeah, well,
Okay.
I think so too. I know. Well, anyways, I don't know.
Well, I have a recording of this if anybody needs the full length 50-minute synopsis. Feel free to grab that from me. Anyway, so let's jump in. Who is eligible for Medicare? So the general rule here is that as you approach your 65th birthday, you need to enroll in Part A and Part B to avoid any lifelong penalties or gaps in health insurance. And so our team here at Steinlage helps you enroll. We make sure you're checking all of the boxes. But the general rule here is that you need to sign up for Medicare at 65 to avoid the gaps and penalties. The exception to this rule is if you or a spouse are working with a large employer. So if you're working for Boeing, if you're working for AT&T, if you're working for Johns Hopkins, you have this ability to opt out of Medicare or delay Medicare at 65 and maintain your coverage through your employer, your large employer, until you're ready to retire, at which point you will trigger a special enrollment window to come off that large employer group health plan and move into Medicare without any hiccups or headaches. So the general rule, you need to sign up for Medicare at 65. The exception to that rule is Medicare is actually optional at 65 if you have access to active employment through a large employer, and that large employer for you or a spouse are offering you group health benefits. Then you can stay on that group health plan through the large employer and delay Medicare until you're ready to come off that group plan at a later date. This is the biggest talking point for somebody who's turning 65. Do I have to take Medicare, or is Medicare optional? So this is where we spend 20 minutes with a prospect or a client to say, hey, you actually don't need Medicare. Your group plan is super competitive because of these reasons. Or, hey, Medicare may make more sense. You'll get more bang for your buck with regards to benefits, pricing, drug coverage. I won't know how to direct you until I have your specific medications, your doctors, your income. So we get pretty intrusive with asking information on our intake form so that we can give really accurate, concise advice on this specific, do you need Medicare or do you not need Medicare? If you are working for a small employer with fewer than 20 employees, or you're on Obamacare, ACA, or you're on COBRA coverage, then you need to sign up for Medicare at 65 to avoid any penalties. Medicare is required for small group plans or ACA coverage, or you're on like a Christian MediShare, or there's a few other like smaller products that people come to us with. But the takeaway here, large employer group health benefits equals optional Medicare. So now here's the refresh crash course in Medicare. Medicare 101. What is Medicare? When you come off that large group plan after 65, or you move into Medicare at 65, or you've been on Medicare for many years and you just want a refresh course, what is Medicare? Everybody will pay zero premium for the Part A benefit if you and a spouse have a combined work history of 40 quarters. So Medicare Part A is free for most of us. And then the Part B medical component on your red, white, and blue card is $175 roughly to get in the door with Medicare. This $175 premium per month that everybody pays for Medicare is based on your income. So if you are a high earning individual making above $103,000 as a single filer, or $206,000 as a joint filer, then Medicare is going to cost you quite a bit more per month than this base $174.70 figure. So I just want to put that on your radar. If you are a high earner, or you have a one-off year where you have a required minimum distribution, you have a home sale, it flags it increases your modified AGI for a one-off year, you will see a higher IRMA income adjustment on top of this base Medicare Part B premium. Okay. In some instances, we can appeal IRMA. Other times you got to ride it out until the next year when that IRMA is removed, hopefully, or reduced. I'll talk about IRMA towards the end. I could go on for IRMA for about 30 minutes. So I'm going to spare Joe and Julie here and the team. But when you get in the door with Medicare in a nutshell will make you pay the deductible for hospital stays. That's $1,600 per 60-day occurrence, a $240 Part B medical deductible per year, and then Medicare covers 80%. There's no cap on your 20% exposure with original Medicare. There's no drug coverage built into original Medicare, plus your deductibles. There's gaps. How do we fill these gaps? When you're turning 65 or you're new to Medicare, you are making a selection. You're making an initial decision. Do I choose original Medicare with a standalone drug plan and supplement? Or do I go with Medicare Advantage, no matter which route you choose, you are still required to pay this $174.70 figure. That's standard and required no matter which path you choose to fill the gaps of Medicare. If you choose this Medicare and supplement combination, you have the ultimate package and flexibility. Medicare is your primary payer. You can go to any doctor that takes Medicare. Then you set up a supplement plan, also known as Medigap. This combination, Medicare plus supplement, gives you close to 100% coverage nationwide with any doctor that takes Medicare. So for clients who say, hey, Margo, hey, Team Steinlage, I want great coverage with no restrictions, and I'm willing to pay for it, the Medicare supplement's the perfect product. You would also need to add a standalone drug plan. There's 30 different drug plans in a given year. We shop those drug plans to fit you or your spouse with the right plan based on your specific pharmacy, medications, and copays, deductible, and premiums all factored in. And we make a recommendation. You'd also add a dental and vision rider here. So here, the positive to going this supplemental and drug plan pathway is that you keep original Medicare as your primary payer, and it gives you access to any doctor that takes Medicare. Okay? The alternative path is you choose a Medicare Advantage plan. These are your zero premium HMO, PPO plans. Now, when you enroll in an Advantage plan, that Advantage plan becomes your primary payer. You put your Medicare card in a safe spot and you only show your Advantage card. Hey, doctor, hey, Johns Hopkins, do you take my network? Do you take my HMO? Do you take my PPO? You pay very little, zero premium for your Advantage plan. But if and when you start using care, you pay for services as they are rendered throughout the year. The attractiveness to these Advantage plans is that they throw in free dental, free vision, free gym, drug coverage at no extra premium. You know, all these extra perks that make these Advantage plans very attractive but are awesome, but the downside is that you are in a networked plan. You got to make sure you're playing by the rules of your Medicare Advantage plan. And sometimes that push-pull can get frustrating from a consumer's perspective. And so it's my goal and my team's goal to educate everyone who comes to us to say, hey, your initial decision is important. If you're healthy and you go the cheap zero premium Advantage plan, know that there's some long-term consequences at play. You know, if you get unhealthy and you're using a lot of care, you can get frustrated by having these pre-authorizations and doctor limitations. And the real kicker here is that if you choose the Advantage pathway because you're healthy and later want to move to a Medicare supplement, the Medicare supplement plans will require underwriting because you're outside of this new to Medicare turning 65 window. So if you're coming into Medicare because you're turning 65 or at a later date because you're coming off that group health plan, you have this unique opportunity to get into any of these plans without medical underwriting. There's no health questions, there's no restrictions on either of these pathways. The supplement plan is mandated to accept you. But later, 2, 3, 5 years down the road, if you went the cheaper Medicare Advantage route and later want to move to the Medicare supplement, the supplements across the board will look at your health. And if you're a high health risk, they're going to say, we don't want you. You're going to cost us in claims. We're not going to make money on you. Now you're funneled into the Medicare Advantage market and product, and you can't get out and go to that robust kind of Cadillac pathway with the supplement market until you're deemed lower health risk, which may never happen. So the takeaway here is buyer beware, because your initial decision will have long-term consequences. You're healthy now. The Advantage plans are awesome. You pay nothing. It's on the back burner. If and when you go see your primary care, your specialist, you pay, you know, a few $100s in service fees, co-pays for the year. But now 5 years later, you're routinely using care, you can get frustrated. And now you're kind of locked out of that supplement market because you're too high health risk. Any questions on that, guys?
Yeah, so I guess with the Medicare Advantage, like you say, is like they have these add-ons or extras that are offered and it has a lower premium. And that's very enticing up front, but that lower premium is also signaling, hey, lower coverages. Is that
Maybe
accurate?
not lower coverages, but more strings attached. More hurdles to jump through to get the same quality care. You know, do I need a pre-authorization for a hip surgery, or can I just go into my ortho and get it scheduled because my supplement will cover it because Medicare is authorizing it? Whereas if you're in an HMO or a PPO, they may put some strings attached and say, hey, we want you to try PT for 6 months before we authorize that expensive surgery.
Mm-hmm.
But yeah, there could be some frustration from the consumer side with these Advantage plans. Not everything is super shiny and attractive. The free dental looks great, but what's the cost? And I would say the headache and the restriction of care is the biggest pinch point and cost to the consumer on those Advantage plans. When they start using care, they become frustrated with the process. Okay. I know I'm on a time crunch. I'm staying smooth here. So Irma, for anyone who is a high earning individual, Medicare is looking at your prior 2-year tax return to set your current year Medicare premiums. So for those of you on here who are already on Medicare, in 2024, Medicare looked at your modified AGI that you had on file on your tax return from 2022. Then in December this year, you're going to get an updated notice saying, hey, for 2025, your Medicare premiums are adjusting based on your prior 2-year tax return from 2023. In 2026, you'll get the same notice based on the 2024 tax return. So this is constantly being updated automatically by Medicare and IRS. They're communicating to update your current year and upcoming year's IRMA premiums. So you're never stuck. But what Medicare doesn't know is if you've had a life event, and I'm going to skip forward. If you are coming off a large group plan and moving into Medicare, you're turning 65, you're retiring and coming into Medicare. Medicare has no idea that your high income from 2 years ago is no longer high because of this life event. You've retired. You have a much lower income in 2025 because you're retiring on December 31st. We can appeal this IRMA in a lot of situations: retirement, work reduction, death of a high earning spouse, divorce from a high earning spouse. We can appeal IRMA and say, hey, Medicare, don't use my prior tax return, my prior 2-year tax return. Use my anticipated income because of this life event. Use my 2025 income, not my 2023. And our team helps you walk through this process. But anybody on this webinar who's already on Medicare, or your parents are on Medicare and they're paying out the wazoo and they've never appealed their IRMA, reach out to us. A lot of times we can appeal this IRMA and save you a few $1,000s, because you can see here, I'm going to go straight to the most expensive bracket. If you're making $750,000 as a couple, Medicare, just to get in the door, is going to cost you $670 roughly, plus your supplement, plus your drug plan, or your zero premium Advantage route. That's expensive. There's ways to appeal that.
And Margo, that's expensive, and they're getting the same thing that somebody's paying $174 for, right? It's not like you're buying a luxury insurance product. It's the same
It's a tax.
thing.
Yeah, it's a tax on the higher income brackets.
So I have a question, and I'm just going to repeat what I got today. I had an electrician in my house, and one thing I don't do is touch wires anywhere in my house. I don't know what I'm doing. Another thing I don't do is Medicare, because it's so complex and so fast moving. So the question the gentleman asked me today, he goes, I heard Social Security and Medicare, they're running out of money. I'm 64. Like, is that going to be able to pay my bills? What's happening with that? So he's asking me the question. So my first response was, I'm going to get you in touch with somebody who actually knows what they're talking about, which is why I'm glad you're here on the call with us, because but how do you answer that question if people bring that up about kind of fiscal concerns of paying for Medicare, paying for Social Security, that line of questioning that my electrician gave me?
I mean, in a very high level, I feel like we've heard that saga for the last decade and we haven't run out of money. So I wouldn't be too concerned with the Medicare side. Social Security, but Medicare has been status quo. They keep increasing the premium. You know, when I first started this, the Medicare Part B premium was $95 a month. Now it's $174. Next year, it's projected to be $185. So squeeze the benefits, increase the premium is probably going to add to the longevity of the program. So be aware of that, buy the right product to protect yourself, budget with your financial advising team for those higher than the normal rate increases. Outside of that, I can't be an expert in the policy. I'm here in DC, but I don't run with the DC policy wonks.
So how does my electrician get in touch with you? How do they start the process of learning more about this? How do we do that? Both for clients on the call and then other people we come across.
Yeah, I mean, shoot me an email, the next 2 slides, and then I'll pop up my email. But I would say shoot me an email and let's jump on a 30-minute call, see where you're at, see what he has. Does he have an Advantage plan supplement? Is he in Medicare? Again, every client's experience is different. Here's my number, here's my email. I can't give one size fits all advice, just like you guys can't. So the key here is start the process early. Once you're in Medicare, our team has you in Medicare, you're in the most appropriate product. We do these proactive reviews because the market is changing every single year. If you're setting your drug coverage and forgetting it, you're making big mistakes, because these drug plans, the Advantage plans, they want you to set it and forget it. They make money, they win if you never touch your coverage, and they slowly or substantially increase your premium or change and modify your tiering structure without you really looking at it. They're making extra money off of that, as opposed to you being a savvy consumer and shopping this every year. This year, more than ever, it's critical to shop the drug coverage. And if you're on an Advantage plan, the Advantage plan, because of this Inflation Reduction Act and the new $2,000 cap on your drug exposure under all drug plans, the plans are jacking up their premiums on the Part D side. The Medicare Advantage product is thinning out their formulary. So your drugs, your Tier 3 Eliquis, that was $47 copay, and you hit the donut hole, it may be radically different. It may be dropped off the formulary. So again, getting eyes on your out-of-pocket and your formulary and your coverage for this upcoming year because of the $2,000 cap is critical. Last year, 25% of our clients needed to modify their plan. This year, it's like 60% that we're seeing. We're already starting our reviews, and I would say 6 out of 10 that I do need to change.
That's it. That's interesting. So they cap the amount of out-of-pocket costs for drug coverage, but the amount of the premium isn't included. So it's you may pay the same amount, but drug coverage is the cost of drugs is capped at $2,000, but the premiums are just going to have to increase aside from that.
Yeah, I mean, this regulation is wonderful for those of you who are on very expensive meds. Okay, I don't want to discredit the work that's been done here, because we've had clients that were on 17, 20 grand worth of meds, and they were paying, 15 grand through the donut hole in years past. Now with $2,000 cap, it's a win for people on expensive meds. For those of us who are not on expensive medicines, we are seeing increased premiums. Skylar, as you're saying, increased premiums to offset the plan's new exposure. Anything over 2 grand, your drug plan, your Advantage plan is responsible for. How do they offset that exposure? They thin out their formularies, you know, less is more, but they don't make it look like that on your annual notice of change. They change their tiering structure so that they're making you pay more on specific medications. And they may drop formulary meds from formulary, and they're increasing the premiums. So we're seeing this real time. Just the importance of a review is critical this year more than any years in the past because of this new structure in the drug plan market.
Well, Margo, I'm glad we have you as a resource to work with on this to help our clients. All this stuff for me, Warren Buffett would call it the too hard pile. This is too hard for me. So I'm glad we have you to reach out to, and our clients can connect. So any clients listening that want to continue the conversation with Margo, please reach out to us or her directly. Her info is on the screen now. And we'll get you in touch to help get the resources, answers to questions that you need. So Margo, I really appreciate you taking the time to meet with us today.
Yeah, thank you guys. I'm gonna
Thank you,
jump
Margo.
off and head back to drug reviews.
Thank you so
Thanks,
much, Margo.
Margo.
This was great.
I look forward to seeing you all again, and thank you again for the collaboration. It's been fun. But I'll see you guys soon, okay?
Thanks, Margo.
Thank you.
All right. Bye-bye.
So,
All
you know,
right.
Julie, when we were preparing for this call, what you told me was, well, Margo will talk for the first half hour and share the insights on Medicare. And then Joe, you can talk about current events and elections and stuff. Like that
Yeah.
wasn't the ultimate grenade to kind of throw me.
Hey, we're still on the topic of current events, so let's shift gears, Joe.
Yes.
Enlighten us.
So, you know, by this time next month, right, we're doing this, we'll have either the former president again, or we'll have a new president, the vice president doing that. So I think it's probably the most common topic that we get from clients in reviews and in conversations of, okay, what's that going to mean? What should I do? What changes should I make? And I think in most cases, unless the goals have changed, it's nothing. I like the JP Morgan, who was a person before he's associated with the company, right? Somebody asked JP Morgan what the market was going to do, and his answer was, it will fluctuate. And I think that's just the perfect response of saying that, because no one on this call, or if you turn on TV, floating heads talking about what's going to happen or prognosticating, the reality is no one knows. But what we do know is the market will fluctuate doing that. So as we come into a especially contentious election season, I think separating our political views from investment decisions are important. You know, I know, Skylar, we were talking to a new client. She's at a title agency she works at, and she was describing during COVID, what they did was they had buyer drive the car up, seller drive the car up. Then they put the audio on in the cars so the three of them could talk, settlement agent, buyer, seller, and then one at a time got out and put the paperwork on the hood of the car to do that. And what was fascinating about that story, and why I'm relating it to the elections, is whatever happens in the world changes in ways we can't predict. It's really difficult for me to imagine a situation where Apple just says, we're going to no longer sell iPhones, or Microsoft says, we're done, we're closing up shop, or we're on, insurance before. We have big insurance companies, Blue Cross Blue Shield, they're not just going to stop business operations. So when we think about investing, at least how I talk about it with clients, and I'm interested to hear your take, is sun will come up the day after election day, regardless of what happens. And the people that work at the largest and greatest companies in the world are going to continue making products and services for their customers. Yeah, it might change, and you might have to do the paperwork on the hood of the car, which is a new thing for everybody, but businesses figure it out.
Well said. Yeah, and I always say we can't control what policymakers ultimately end up doing in passing, but we can always take advantage of whatever those rules are. We have to educate ourselves so that we can educate clients to say, hey, the tax code has changed. Here's how this can benefit you. There's a downside to it on this side, but there's also positives. So let's get together, talk through it, and then find out the best way to benefit your family moving forward.
Prime example is the cap on drug coverages affecting the cost of medications. So you got to review those coverages here.
That's right.
Yeah, and I'm talking about some of those companies. I like this picture, so I'm going to share my screen quick. Let me explain what I'm looking at. So this is a lot of times in our review, and I think in probably every portfolio, if there's an exception, I'm not aware of it, is going to own the S&P 500. And this would be the 500 largest stocks or companies in the United States. So this is a picture that shows the attribution or how much these companies contributed to the return, both green, positive, red, negative. So in this past year to date, NVIDIA has kind of been the story of the market, right? It has been for longer than this year, but for a period of time. So NVIDIA, when you see the return of the S&P 500, a lot of that has been driven from NVIDIA. This is Meta, or what a lot of us may call Facebook. I mentioned Apple before. So these are the companies that have contributed the most to the return. So the S&P 500 is weighted by the size of the companies. So the largest companies contribute the most. So whether Apple goes up and down, it's going to have a larger impact than the 499th size company in that index. And then you see the detractors, Intel being the big one here, Boeing down as well. So what this chart always shows me is I don't know next year which are going to be the top contributors, top detractors. I wish we knew that, right? That'd be great to know, but really nobody knows that. But it'll be something. And what it also illustrates to me is the average company or the average stock loses money, but the market itself grows or makes money over time. So to say that again, the average company loses money, but the market itself grows over time, typically somewhere 8 to 11% per year, depending on the range you're looking at. So why is that? And why that's happening is there's certain companies that drive that return. 5-6 years ago, very few people knew the name NVIDIA, right? Or could pronounce it when they see it. And then now that's the biggest driver of what the returns are. Before that, it's Tesla. Before that, it's Apple, right? It's always been something that's contributing to that. So why I said earlier is all the clients own that market mix is whatever happens after election day or whatever current event occurs, a war, a pandemic, any event that happens, that's essentially the way capitalism and free markets work. Is there's companies that are figuring out how to provide the product and services that the market wants. And I'll pull up that chart in 3 months and it'll be different names on there. It'll be different names 3 years from now. But the philosophy we subscribe to is, hey, if you're owning all of these, the market itself will drive returns. If you're picking the individual stocks, the average stock is going to lose money. So you might get lucky, right, and get the right one, and that certainly happens. But it's a very difficult game to replicate over and over.
And sort of on average, like you were saying, and this is going to be specific to the S&P 500, you're saying that the average company may lose value, but overall it gains. If we're looking overall, on average, the market will have intra-year drops of about 14.2%, but over the last 44 years, 33 of those years have been positive returning years. So not only on average do companies are they positive, they have a consistency of roughly 75%, 3 out of 4 years are going to be positive. So not all companies are going to have positive returns, but the market itself is positive and a majority of the time, historically.
Right. And that's why we always say time in the market is so much more important than trying to time the market, because we never know when the big days are going to happen in the market. There's been studies that show most of the largest moves over a course of a year happen when there's no news. So we always try to attribute things to news or events. Reality is the market is a beast of on itself, because it's a multitude of people, millions of people making decisions on how to invest their money, where to invest it. And the market kind of produces that a mind of its own, as we call market sentiment, and it drives return over time. And most people are betting that, hey, things are going to be better over time. So that's why we always want to stay invested, stick to your plan. If you have a plan going in, then whatever happens in the election is not going to change that plan because it's built on a solid foundation. We'll always go in, review, make adjustments, but for the most part, the correct plan is the one that you already had.
Hey, Skylar, can you bring that chart back up? Do you still have that?
Yeah, let me, I moved on to my next one, so
Just
let
so I
me,
don't say the wrong one. I think that chart went back to 1980.
Mm.
If you can see it from on there, but if we looked at the 500 largest companies in 1980, do you think we would have seen Facebook on that list? Or
Definitely
Nvidia?
not.
Right? So these companies today that are part of our daily lives didn't exist at that period. Or another example, hey, Julie, when you said about your career working before, what was the first smartphone that everybody had? If you're thinking of professional context, what was the brand of the smartphone?
BlackBerry?
Blackberries, right? Everybody had a BlackBerry.
Of course.
I had a BlackBerry.
Oh, yeah.
What do you know with Blackberries today?
Very
Right?
few people.
Yeah.
Very few. So it's changed in that. But I mean, if I would have said that to you 15 years ago, you would have said, well, everybody's got a BlackBerry, of
Right.
course. So
Or pagers.
or what? Yeah, before we could go back, Motorola pagers, right?
Pagers.
The 1980, the companies that comprise this index are not completely different because we see some Johnson & Johnson, Exxon, McDonald's, some companies still throughout that, but a big percentage of that has turned over. So Nav's right, like you might not be changing your strategy, so to speak, but the funds or the investments themselves have kind of a cleansing process where companies are going out, companies are coming in as the marketplace changes. Skylar, if you had another one to go to, I'm sorry if I.
yeah, that's all right. I do have a new one to bring up.
You know I like charts and pictures, so.
I do too.
I think the other topic, Scott, while you're pulling it up, is we've seen a big change in interest rates, which has been a big conversation with clients. So when we had interest rates for the longest time at very low periods, that's commonly discussed as like, ooh, that's really good because we can borrow money at low rates, which is true. If you're going to buy a house or a second home or need a loan for the business, low interest rates are good. If you're a saver with cash or CDs or bonds and you're looking for fixed income, low interest rates are bad if you're the one with the capital. You're the one lending it out. So we saw interest rates spike over this past year. It's got a wrong screen.
Oops.
So we saw interest rates spike this past year, and that's commonly expressed in the media as being a negative. And that's true if you're going to go buy a house and borrow money. High interest rates are a negative of doing that. What we've seen in the last couple of months, and the Fed's trying to push this direction, is to decrease rates again, or essentially to cut rates. So when we're thinking about how we're saving our, sometimes I hate this word, but I'm going to use it, safe capital, like the money that we have in cash and CDs and the bank, money that we don't want to fluctuate with the stock market. If we're in cash right now, we're probably earning 4 or 5%. The challenge is we're kind of renting that yield because that's where short-term rates are. And if yields drop, if rates drop again, that bank rate is going to drop first. So that CD rates, the money markets, the savings accounts, those rates are going to drop first because you're effectively renting that income or yield. You have the opportunity to own it, so to speak, in a bond or in an annuity product or something where you're locking that rate in for a period of time. So interest rate discussions sometimes put a lot of people to sleep. I'm a big nerd, so I like talking about them. But it's important to kind of think critically of, okay, for the safe bucket of money, how am I managing interest rate risk? Scott, I think you have a nice picture to walk us through this.
Yeah, actually, I was bringing this up. I thought Nav wanted to talk about interest rates and everything.
I do. And this is a really good one because I'm going to contrast this chart, which shows the yield curve, which comprises of the low end of the curve, so 3 month, to all the way to the long end, the 30-year, with where we are from 2023 of October, July 3rd of 2023. And both of these parts is when the yield curve was inverted. So that means the 10-year and the 2-year. The 2-year was actually higher in July of 2023 than the 10-year number, which generally means that you're getting more bang for your buck if you're investing for the shorter term, generally because you're getting a higher yield for taking less risk. where on the longer end, you're getting less interest rate and interest payments from taking more risk. So generally, the market was going to be moving to the lower end of the curve. What started happening is the Fed started talking about lowering interest rates. And we finally did get an interest rate cut in September of this year. But what you see is leading up to the interest rates is that the September 30, 2024, the yield curve uninverted. So that means the 10-year number, the 10-year yield had gone above the 2-year because the not only the Fed cut rates, but we're saying, hey, maybe inflation is finally coming down, maybe they have it under control, and we can start anticipating a more steady, normalized interest rate environment. And then what we've seen since September 30, 2024 is 3.8% was the yield on the 10-year. Right now, it is at 4.03%. So it's actually increased where everybody was saying, hey, the Fed's cutting rates. Now that means that bond interest rates are going to come down. That means lending prices will come down. Mortgages rates will come down. What actually ended up happening is the opposite because the market anticipated the Fed cut, got it. And then the day before the Fed rates happened, markets started rising because they look at it and say, well, the job market is actually looking pretty decent. And we just had a much bigger beat on the markets for September that just came out earlier this week. And that helped push the rates up in advance of that. So now instead of mortgage rates coming down, they've actually gone back up and they're at 6.6%. We've actually seen credit cards have not come down like people anticipated. And that's because the Fed really only controls the 1 month pricing power for the yield. So Scott, if you actually let me share my screen real quick.
All right.
I will show quickly what I'm mentioning here. Can you see that okay?
Yep.
So when we look, the Fed moved their interest rates down by 50 basis points, which is 0.5%, 0.50. And now it's between 4.75% to 5%. And we look at the effective rate, it's actually right exactly at 4.831%. This is showing the US Treasury bonds, the month on the left-hand side, all the way up to 30 years, the yield, so what you could get if you bought that security today, the yield on that, and then just the change of what happened intraday. So this is as of today, and the 4.831, that's where the Fed has the most direct control because that's where banks exchange money rates from.
Yeah.
3 months, pretty close. Sorry,
Now, this is, so when I look at this, we use the term inversion, right? Because we speak in this language, but it's backwards to what you would think. Like if I was going to lend Nav Simpson money for 5 years, I would expect to get a higher rate of return than if I was going to lend Nav Simpson money for 1 year. Because a lot of things can happen in 5 years, right? Your financial situation could change, relationship could change, market environment could change. So you would think that the 5 year you'd get a higher return on that. But because it's inverted, those shorter term loans are actually yielding more than the longer term ones. And a really insightful point you made, Nav, that I want to come back to it. I had an advisor, a financial advisor friend of mine email me and he said, the Fed cut rates, but yet rates are going up. What's going on? And that's the point, Nav, you made is effectively the market is already deciding that.
Exactly.
So the market is deciding that regardless of what Federal Reserve decides they're going to do, the Fed has the control on kind of that one lever, but the market is determining this is what we say the price should be for 5 years and 7 years and 10 years on that. So it's hard for me to wrap my head around sometimes how that inversion works. It's counterintuitive to how you would think, but it's the market setting prices is really what's happening there.
Exactly. The market doesn't follow the Fed. The Fed actually follows the market when you really look at it. And the 10-year number, which is what is most of the loans are based off of, not the 3 and the 1 and the 2 month. That's more driven by growth expectations and inflation expectations, much less of what the Fed funds rate is. So if the market thinks inflation is going to come down over the next 10 years and the yield is higher than what that is, then it might drop, or if growth might be less, the yield will come down, regardless of what the Fed does. So we want to just give context to why this move has happened after the Fed actually started cutting rates. And it's because of inflation expectations and possible growth that the market is seeing for the future.
And now that's a good point. And to Skylar, I'll ask you this one. It's like if I'm getting 4% or 4.8% on my savings, why would I buy a 7-year bond or a 10-year bond? What would be the argument, or why is the market pricing it that way?
The reason being would be that they're expecting the rates to come down in the future. And so you can get that higher rate of return in the short term, but kind of pricing in down the line, if I could get a higher rate for the next year, that might be great. But if rates come down next year, then I'll have missed the opportunity to get that higher end yield for that longer period of time. So, 4% yield might be good for 1 year, but if I have to do that to forego getting a 3.8% locked in for the next 7 years, then that might not be the greatest move. And in terms of fixed income yields, I think things are looking still very attractive relative to what the 10-year average has been, sort of almost across the board. If you look at it, the range of yield over the last 10 years at its lowest point versus its highest point for each of these different fixed income asset categories, we have U.S. Treasuries, municipal bonds, investment grade corporate, mortgage-backed securities. What ABS? Do you know what ABS is?
Agency-backed securities.
Agency-backed securities. All right, so those are quasi government. European investment grade, emerging markets. This is kind of your risk profile for going up. But you can see that kind of the average here, yields relative to the average and relative to the range are still fairly attractive.
Yeah.
So, if I could have gotten 1.9% over the last 10 years on average from a treasury, but today, if I were to be able to get 3.8, that's pretty good. Same with municipals, and this would be, a lot of municipals are not subject to federal, and if it's in your same state income tax, municipals are looking very attractive.
Yeah, and this is where we see as part of a portfolio that bonds have not really provided much in terms of return. But we think with higher yields where they are above the average they've been the last 10 years, we're likely to see that contribute to returns, or at least not be as much of a detriment to returns as they have been over the last decade. So if stocks are in 7 to 10%, yeah, there's no numbers on this page with the exception of the very riskier loans earning that level, but your safer bonds should now be generating in that 3.5 to 4.5% range. So at least we'll contribute with returns and then hopefully keep up with inflation, which effectively is the point, right? To keep purchasing power and to grow that wealth over time in terms of purchasing power.
Yeah, because sort of the role of a bond in a portfolio is twofold. One is it's supposed to generate income, which they were not doing well, at least. Now they actually are being able to perform that role. And then the other role of it is a ballast for diversification. When your other asset classes are not performing, you will have some modest performance in the bonds, which most years they've done that, but with the big drawback in 2022, we're kind of not yet breaking even yet.
Yep. Right. So as we come to you mentioned 2022, as we come to the end of the year, I know we're working with clients to do some year-end planning of what can get done. The big call I was on today was 529 contributions. So for Maryland friends, it's $5,000 per beneficiary. So in this case, the woman had 5 grandkids, $5,000 each. She can do $25,000, so 5 to each of them, and that's a deduction or subtraction from income on her Maryland return. Virginia's $4,000. Each state is a little different, so work with your advisor depending on where you're located in the country. But that's a 12/31 deadline. Some of these are tax year, April 15th. The 529s are before the end of the year. So that's the one top of my mind before the end of the year. Now, what are you working on before year end?
Yeah, our required minimum distributions, that's always a big one topic for end of the year. So want to make sure that all clients that we manage assets for do get those out for 12/31. And if we don't have those assets and you have it outside of us, make sure that you're working to satisfy those RMDs, which is now age 73, if you're age 73 and above.
Hey, Nav, can you talk about combining charity with that? Like I know we just did with that recent client.
Absolutely.
Talk a little bit about that strategy.
Yeah, so qualified charitable distributions or deductions, that is a strategy where if you are 70 and a half, you can actually give money out of a traditional IRA or a beneficiary IRA directly to a charity. So you're taking money, instead of taking the distribution, paying taxes on it yourself, and then giving cash to the charity, you give it directly from the IRA. You don't pay tax on the distribution. The charity doesn't pay tax on the distribution. And if you do it before you take your RMD for the year, it can actually help satisfy your required minimum distribution for the year. It's a really powerful strategy that is available for 70 and a half. So it's even before you turn RMD age, which is now 73.
Yeah, I think that's, and you can do up to $105,000 per person. And I think it's a very helpful strategy in a circumstance where you don't really have a lot of itemized deductions. Because if you want to be charitable, but you also want to be tax efficient, you want to make sure that you're not paying tax on that. If you don't have a lot of if you don't have itemized deductions, you may not be able to get the tax deduction there. And then like we talked about earlier with IRMA being able to kick in, if you were to take that RMD directly and pay tax on it, now that's going to hit your income before deductions. So that could trigger the IRMA versus being able to pay it directly to the charity, and you avoid that altogether.
Yep.
All right, guys. We're almost to the end here. A few new business updates. I wanted to mention, we did hire a new executive assistant. Her name is Jenna Parks. She works with Greg and Joe. So you may also hear from her from time to time via email, maybe scheduling your annual reviews. So she is a new wonderful addition to our firm. There's also, I saw an email come through about some enhancements to Account View. So your Account View 2.0, I'm not exactly sure if you guys know what the enhancements were, but we recently got an email. So I wouldn't be surprised the next time you go in, it may look a little different, may have some new features along with the Wealth Vision software. I know that they're continuing doing enhancements on that end too. So definitely check out your Wealth Vision portal as well. So
yeah, if you don't have access, be sure to reach out for that.
Yeah.
I also know we have some clients who maybe they help with their parents' financial, so we can get access to the child as the power of attorney or the trustee in that situation to access it. But please reach out to us. If you reach out to me, I'm going to tell you I don't know how to do it and probably direct you to people smarter than me. But make sure that you have online access. Certainly, you can still continue to get paper statements that come out quarterly. That's not going to change. But just in today's world, mobile app, online access to both Account View and Wealth Vision. We want to make sure you have that at your fingertips.
yeah. We just wanted to thank everyone for joining us. I know as strange as this sounds, the next time we'll be seeing everybody is in the new year, believe it or not. So we just wish you and your family a healthy and safe holiday season. And we look forward to continuing serving you guys in the years to come. So with that said, I think that's about it.
Thanks,
Unless
Julie.
you guys have anything else.
Thanks, Julie.
Have a good rest
Well
of the week.
said. Thanks, Julie. Thanks,
All
team.
right, take care.
Thanks for joining us.